Hello, everyone. Welcome to the CUBE Pod episode 86. I'm John Furrier with Dave Vellante, our weekly CUBE Pod. Dave, salute from the West Coast.
John, almost Merry Christmas. I got my red tie on.
Yeah, I was just in a meeting with our team, Kent and the team, Frankie around the platform, the AI cloud, getting some end of year stuff, getting ready for 2025.
Snowing out here,
Have a
snowing like
little
crazy.
party in the office today.
We might have a
Yeah.
white Christmas for a change. It's snowing like really pouring snow.
Yeah,
Is
it's that
snowing
time of
there?
year. We got to get the snow in the East Coast. We got to get the skiing up in Tahoe. We got to get all the decorations up and get the cards out. Happy holidays to everybody. And so we got to get that done. A lot of stuff work to do on the break. I'm not traveling. I wasn't going to go to CES, but now I'm going because IBM and others. I got meetings set up, but I'm not going to do the cube. Maybe the pop up opportunity, but we'll see. CES is in January, then NRF in New York City. Take some time off to recharge. I had a brutal grinding. We've been grinding for 3 weeks. We're going into reInvent, the whole team. Got a great content. This week, the CFOs in AI was the big focus here in Silicon Valley with our NYSE collaboration with Brian Bauman and the NYSCS. We've got the new set over there. Everyone knows that. And we're doing the digital twins, but we're doing an event. We did a first time ever event with theCUBE around CFOs and AI. I got to tell you, I was excited by this and energized by it because we found that CFOs were leading into the conversation more and more in AI, but I'm blown away by the results. We had a reception in Menlo Park. All the top CFOs in Silicon Valley were there, leaders too, not pretenders, all the ones leaning into the business model transformation. And it dawned on me, Dave, that the CFO, and this was a real connecting the dots moment for me, was that the CFOs themselves are really the ones that should be leading the business transformation because we are in a time now where productivity and labor, we talk about this all the time on the pod here, is front and center. And here's why I think this is so important. This is a new data point, and it's an epiphany to me. Obvious now that I look at it. If you go back 20 years, 20, maybe even 30, 20 years, say 20 years, the number one conversation was the consumerization of IT. And that was making IT easier for the people who deployed and racked and stacked racks, ran Cisco routers, did software, loaded apps, on-premise activity, the data center. And we started to chronicleize the democratization with Web 2.0. And then when, around 2010, when we started theCUBE, it was all about hyperconvergence in the data center. And of course, cloud hit the scene like it's nobody's business and ran the table. And then we entered the SaaS mobile era. Jerry Chen points this out from Greylock on theCUBE. We did a great interview at reInvent on this whole dynamic. And then it became digital transformation. Digital transformation was, yeah, go to the cloud and basically digitize your company. That continued, but with the AI wave, the digital transformation is turning into business transformation, business model transformation. And all the conversations are basically in the lap of the CFO and the CISO and the CIO and the CXOs everywhere. Product leads, product led growth. You're seeing a shift on how people are buying technology. It's no longer a decision maker, recommender, and influencer like the old way. It's now collection of decision makers, different personas making a decision and together. So that's one dynamic. The other one is that the CFOs, I mean, their whole job is to, besides the bean counting and the speeds and feeds of the balance sheet and income statement and cash flow, their job is to match the financial strategy of the company to the business strategy, not the other way around. So most great CFOs are tuned into the business strategy and making sure that the financial strategy matches lockstep and funds the money, so to speak, revenue, cost optimization, cost efficiency to the business model. And since AI is changing the business model so radically in these companies with AI, it's addressing the cost equation to the bottom line as well as revenue. So that's one. And finally, it dawned upon me, this was my biggest epiphany, is that the CFOs know the blueprints of an organization. Think like building a big skyscraper. You got to get an architect to draw the blueprints up, and then they do the build out. CFOs know all the linkages. They know all the interdependencies. They actually know the business architecture better than anybody. And so when you get into these conversations around end-to-end workflows, data silos being busted down, it's the CFOs that will be able to identify the linkages to connect and re-architect for more money flow. And this is fundamentally real. And we had a variety of great CFOs come on. We're going to do this in New York City. Again, Silicon Valley hub here with Palo Alto studio. We'll do it in our studio in on the stock exchange floor, connecting Wall Street and Silicon Valley techies. This is real. And now you're seeing all the CISOs and CIOs like Lori Beer at JP Morgan Chase. They're thinking like CFOs. How do I hedge my supply chain risk? How do I do risk management and governance? So, and even into the total cost of ownership, all the payback, all the ROI conversations are all impacted, and they can't sit by idle. And the CFOs that are smart, they're leaning into the business model innovation, and that is fundamental. And then I was not sure how to the extent this would be, but it's very clear as day that the CFO can't be a passive bystander in the
Well,
equation. So I'm so excited and completely re-energized by this, and you'll see a lot more content coming.
well, the CFO, to your point, has cross-functional uh, observation space, obviously, and the old saying, "Follow the money." But what I want to point out, first of all, I love the website. I love our Cube 365 platform, the linear clock, and it's playing right now. Go to thecube.net. You can see the lineup. But what strikes me, you had 25 guests. A quarter of them were women, which is very cool. Now, I interviewed Karen Walker at NYSE at my CXO event, a media week, a couple weeks ago, several weeks ago, about a month ago now. But 25% of the CFOs that you had on the program were women, 25, 26%. So that is awesome. I'd love to see 50%, but I think the industry average in tech, I think, is 15 to 17% of female. So that was kind of cool. And I think, the other point is because they have so much operational, knowledge, they can directly affect, this AI transformation. And I really like your point about business process, business transformation, and specifically business process transformation. It's something that George Gilbert and I talk about a lot. In fact, it's a topic of breaking analysis this week. That not only do you need data harmonization, but you have to actually be able to incorporate and harmonize business processes across the organization, and that's going to be a lot harder. Data harmonization is hard enough, and that's why when people talk about agents, the 2025 being the year of agentic AI, it's probably going to be the year of agentic AI washing, but it's going to take some time to play out. It's going to probably take the better part of a decade to really be absorbed within these organizations because it's not just a technology problem. You've got the business process that has to be completely reshaped. We don't want to pave the cow path, as they say, and just try to bolt on agents and digital assistants. We really want to rethink the business processes, and that's a hard problem, and it involves people.
I mean, people process technology has always been that process improvement from the Drucker days back in the 80s, 90s. Now it's more than ever. Again, that's your point. You're going to see a lot more. I think this is going to be a real game changer for how people go to market. I think we've identified this week that the enterprise is such a hot market, and the ability for the incumbents who are already in that market, the Dells, the HPEs of the world, the Oracles, IBM, you name it, all the big players that already have historically had multiple cycles of success in these enterprises, can attract the startups and the developers, not by having them program on their cloud, or in this case, some don't have cloud, but the tech stacks of the new developers will have to align with the enterprises. You and I talked about this off camera this week a lot around how companies who are trying to win the developers. I always hate that word, winning. There's no winning the developers. They pick you. That's how it works. You win. They win you.
They win you. Yeah, right.
There's no. I mean, I hate this whole. I got to win the developers. You win the developers by being good and solving their needs, which is get their product out in front of customers and making money and solving problems. So there's a huge shift I'm seeing from developers in open source around certainly Llama models and the open source frameworks where, yeah, they're going to use Amazon Web Services, the #1 cloud, and others maybe, but ultimately they need to get into the enterprise. So they're going to have to deal with the existing players, and you're seeing a lot more AI being discussed in the AI stack around integrating in with existing stuff. And this is not on the radar of most people's conversations. Certainly, even on valuation discussions, market opportunities, and even the companies themselves on their go-to-market and their product marketing. They're trying to have programs that target developers, and they're trying to say, use our technology versus integrate our technology into your stack, cloud stack, to be compatible in the enterprise. This is huge nuance, but it's absolutely could separate the winners from the losers. And so I think there's going to be a huge surge back from the, I call old guard or the existing install base, like the Dells and the HPs of the world, because their gear is there and they're building software stacks too. And so NVIDIA, I think, is creating a biz dev opportunity for the ecosystem to have a connected to the cloud distributed computing architecture where it's not a zero sum game back. It's not like they lose if they play their cards right. If they play their cards wrong, they could lose. So I think there's going to be some companies that are going to bet wrong on this, Dave. I'd love to get your thoughts on this because this is a bet. It's a strategy bet, and the why is no one's going to go to a non-scalable hyperscaler for tech stack, in my opinion. They're going to roll their own integrated stacks and then make that customizable at the infrastructure level, the AI infrastructure level, in production, where the agents have to work with the different systems, SAP, Oracle, you name it. They got to work together. So, Salesforce wins, Dell wins, SAP wins, VMware is going to win. I mean, I think VMware. I mean, you look at VMware. If you left VMware when Broadcom bought the company, you missed 7x step up on stock price, right? So again, this whole idea of the old guard is going to get decimated. I don't see that, Dave. I think there's going to be some staying power there for the right bets, but it isn't
Well,
buy my technology only.
so the thing is, there's hundreds of agent companies, AI agent companies that are being funded now. And so point number one. Point number two is every application company is doing their agents, whether it's ServiceNow or Salesforce or Oracle or Workday, you name it. They're all doing their own agents. So the concern I have, John, is that for 5 decades, we've got a 50 years of essentially enterprise application stack, which is just a siloed stack. We've got my ERP stack, we've got my Oracle Fusion stack, we've got my Workday SaaS stack, we've got all these SaaS stacks, and all my business logic is locked inside of those stacks. And Microsoft, of course. So how are all these agents going to get access to that business logic? Are they going to do connectors? Okay. What kind of tax are they going to have to pay to get to those connectors? Salesforce is just going to say, here you go. Here's all our data. Microsoft, here you go. Take our data. No, they're probably going to license the access. And so, that's going to be an interesting economic model. So the big question that I have is, are we perpetuating more silos, data silos and business process silos? Because to your point, you have to rethink your business processes and integrate those business processes in order for agents to be able to act on them and act on behalf of humans or with humans. And so how is all that going to be come together? Or are we just going to be within our own silos, being able to have silos of automation, just like we have silos of application automation for all these years? And so if that's the case, where we're just perpetuating more silos and these big guys have so much market power that they're going to be able to control their own silos, same thing with the cloud guys, then it could be another promise of the tech industry that isn't fulfilled, like Hadoop or like 360 customer or like data warehousing and so many promises that were never fulfilled. I mean, cloud actually, I think, delivered on its promises, and I think to a large extent SaaS did, although there's a little bit of a backlash there. But that's the big concern that I have looking forward, is we have to bust down those silos in order to have this 10x impact on the economy.
Yeah, and I think the economy and the productivity equation go hand in hand, and I think this is why the CFO thing got my attention, is because the economy will be driven by the productivity, and it's one of those indicator data points that will probably come up in the numbers. I was reading the news and watching some coverage and researching the Fed impact, the Fed moves, which impacts a lot of the things going on now. And if you look at the neural rate, it's interesting how the data points. I think productivity and job creation will be a big factor. AI is not going to take more jobs. I think it's going to create more jobs and more productivity. So I'm a big believer on that. So I think you look at that, then you say it clicks in, and this is why the market is so hot for startups right now in AI. If you look at just the data, Dave, just on funding from a valuation standpoint, Databricks raised $9 billion at what, $65 billion valuation. Perplexity raised
62, I think.
it's either way, it's in the stratosphere of essentially why even go public at this point. Perplexity raised half a
Well, I got
billion.
thoughts on that.
Okay, so that's a big one. You got Google making the announcement. They had a quantum announcement. They had an update to their AI. OpenAI's got some new train of thought features. Meta, they're all releasing the new models, right? So this is where you start to see even Salesforce beefed up their agent force. They got some stuff hitting the market. So the market is being identified as a growth market because of the valuations. If you look at Broadcom's performance and their earnings, the chip side of it's growing significantly. The chip company CEOs that I've been talking to in a lot of the AI leader conversations, part of our showcase there, they're all doing extremely well. And the question is, where in the cycle will they be? So all the market indicators are pointing towards growth in AI, and everyone who thinks it's going to be a bubble bursting, it ain't going to happen. I think it's too many things going on. Um, it's just out of control in terms of the valuations, but notwithstanding, there's market there. So I think the investors are saying, I'm betting on the growth. I'd love to get your take on it because I know you've been critical of say Intel, but if Intel and is replaced by NVIDIA, does it matter? Does it if the tree falls in the forest, does anyone care? Right? I mean, really.
Well, I mean, my issue with Intel is in the context of what you just asked about NVIDIA is NVIDIA doesn't make its own chips. They rely on TSM to make the chips. And Intel has a big investment in Foundry. They have $100 billion, literally $100 billion of plant property and equipment on their balance sheet. And the balance sheet is a nightmare, as I heard Jim Cramer pointing out today. And I still think everybody has it all wrong. I mean, I hear people saying, well, you can't really spin out Foundry because Intel, because it's really of negative value today. So you can't spin it out until it turns a profit and then they can, get some cash for it and actually have a return. It's over. People forget in 2014, Ginny Morometti decided to sell the IBM Foundry, the microelectronics business, to Global Foundries. Well, the reason I put sell in quotes is because they actually paid Global Foundries, I think 1.5 billion or maybe it was 3 billion to take it. No, they 1.5 billion to take it, and they committed 3 billion in the next 5 years, I want to say, in research and development in exchange for like priority access to advanced chips, which at the time I think were 7 nanometer. Well, guess what? Because of Wright's Law, Global Foundries realized that it couldn't compete, Wright's Law being, the volume economics of semiconductors. And so Global Foundries basically said, hey, we're tapping out. We can't live up to our commitments. So IBM sued to get its money back. But the point is that Intel is in the same predicament. It's actually ironic to me, John, because think about it. Intel inherited IBM's hardware monopoly when IBM gave it to them with the PC. When IBM said, here, Intel, you take the microprocessor and Microsoft, you take the operating system, that handed IBM's monopoly, which was dominant at the time in the 80s, over to Intel and Microsoft, respectively. And now here you have Intel's monopoly unraveling in much in the same way as IBM's, for different reasons, obviously. But it was a volume game. Intel got all the semiconductor volume in the 80s and 90s, and left IBM in the dust from an economic standpoint and productivity, price per performance standpoint. And the same thing's happening here. So, my thinking is that we have to have U.S.-based advanced manufacturing. I think it should be, in my opinion, a U.S. headquartered-based companies, and I think it should be funded by not only the U.S. government with the CHIPS Act, they should redirect that, but I think Apple, Alphabet, Microsoft, Amazon, Meta, and even a little bit of NVIDIA should throw in some cash. I think Elon should throw in some cash too. I think collectively on their balance sheets, not excluding Elon, these companies have more than $500 billion on their balance sheet. So if they each throw in $5 billion, NVIDIA throws in 2 billion. Elon throws in 2 billion. You give them 4 or 5% of the surviving entity, you get private equity to put in another 20 billion. Why would they do that? Because they're already tens of billions of dollars in deep. So they're just going to go, lose all that if they don't. And you redirect $30 billion in the CHIPS Act, and you give Intel $100 billion. And you say, you got 15 years to figure this out. You bring in a governance structure that is focused on a new mission, which is to get U.S. competitiveness back, onshore. And again, I've said this many times, the problem with Gelsinger's plan was it was flawed from the start because Intel was going to go bankrupt trying to achieve it. And his objective of vertical integration was a bold one because vertical integration means you can dominate the market. But I think he suckered the government. I mean, the goal was not to allow Intel to dominate the market. The goal should have been and still should be to establish U.S.-based advanced manufacturing. And so it doesn't matter. It should not matter that this organization is vertically integrated. In fact, in my opinion, it should not be vertically integrated. And the thing that I think everybody misses, I heard Kramer this morning, well, Intel's balance sheet is a nightmare. Yes, that's true. I don't know what's going to happen to the design business. The design business will flourish if you get Foundry off its back. And that's what should happen, in my opinion. We've only been saying this for how many years? Literally years.
What was the
a decade.
reaction to your breaking analysis? I mean, the idea of doing a new co and spin co into Global Foundries was a compelling idea.
Yeah. Well, I asked Matt Garman publicly in the Q&A session. I don't know if we talked about this on a previous CUBE pod. I asked him, does it matter if we have U.S.-based manufacturing? And he's like, yeah, it matters. Does it matter if it's a U.S. headquartered? He said, nah, I don't think so. And would you be willing to fund it? And he's like, not really sure I want to fund it. No surprise there. So that was kind of the initial reaction. One of my M&A buddies said to me, well, Dave, why bother going through all this mess? Why not just start from scratch? And the problem is, even though the value of its foundry is negative, it's actually well on the way to building out foundry capability. David Furrier estimates it's going to take 3 cycles of foundry factories in order to get to break even. And so Intel's already well on its way. If you had to start from scratch, forget it. It would double the amount of time it's going to take. So 3 foundries are going to take 6 years, add another 1.5 to 2 years to actually get to yields. So you're looking at a 10-year horizon. If you were to start from scratch, it's probably more like a 20-year horizon, the time it's going to take to raise the capital, to actually acquire the assets. So that my view, doesn't make sense. But I thought it was an interesting comment because, it was not somebody who was deep into the semiconductor, manufacturing world, just sort of an obvious question. The other comment I got, which was, I thought, really interesting was, again, Ben Baharin said, well, they're going to have the same problem that AMD had when it spun out its foundry, is they have to commit Intel would have to commit some amount of supply or business to the foundry. And if the foundry can't give it good yields, then they have a paradox. And my feeling is that's part of the problem here that Intel faces. And that's why they need a 10 to 12 year runway. And so I don't see that as any other point he pointed out, same as Patrick Moorhead a while ago. Now's not the time because they would lose money. The end game should not be to help Intel, save its ass and make money. It should be to have it save its ass. And to do that, they got to get Foundry off their back. And that's kind of my take.
Well, let's keep an eye on that for sure. We got a couple things in the news that's worth talking about.
Can I just bring up one thing on Databricks?
Sure.
$10 billion, $62 billion. Just as a data point, Snowflake is valued at $55 billion.
Yeah, I mean,
just let that bake.
Well, I mean, public markets, private markets act differently. So, I mean,
Yeah.
if you're Databricks, I mean, they're looking at a run rate in billions of dollars a quarter, and we're hearing all kinds of interesting topics around their business growth. And again, why wouldn't they be successful making all the right moves? Again, Databricks, Perplexity, They're all coming out of Cal. The Cal group. Pete Soncini was on both boards. He's also on the board of Scale. Pete Soncini, formerly with NEA, just announced a new fund, Laud Ventures, and he just announced a early stage firm. He's partnering up with the founders. He was a um, big time VC in at NEA for years. Started out his career at Hewlett Packard. He and I were fellow travelers at HP, Hewlett Packard back in the 90s. I lived in the East Coast. When I moved out here, he then joined a company called VMware early on. I think he might have been like the eighth employee there, but he was early. And he's got pedigree. His father is the owner of Wilson Sonsini, but he's a Cal guy. He loves the investment in Cal. So his investment thesis from day one has been look at Cal ecosystem for startups. And if you remember, since theCUBE started 15 years ago, a lot of great ventures came out of Cal. If you look at Databricks, I mean, they rose out of the ashes of the Hadoop failure, and they had they leveraged open source Spark, and then they, obviously jumped on the data lake bandwagon and made it really easy to work with data, but they took the promise of Hadoop and made that happen. And then you have a great computer science program and now cross-disciplinary action at Cal, and Stanford's good too. Stanford people will yell at me for leaning to Cal here, but Cal's got great pedigree. So Laud Ventures is the new firm. I think they got close to 200 million in funding from limited partners. But Andy Konwinski is with him. He was, a big part of the foundation of, Databricks, right? Arvind, he was at Perplexity. Um, they got the early stage stuff. They get really super early. These guys pick them right out of the gate. Their whole thesis, and this is the antithesis of venture capital. And so, I think democratizing venture capital is going to be something that's going to be a big part of the Valley and the global scene. Certainly, New York's seeing a lot of action. We're seeing that with the Cube there. I think the Cube region, as we expand, we'll see more. But the formula is get the ventures at the formation stage. And if you look at the history in the past, say 6 years, certainly leading up to the AI wave, all the early stage deals were pretty much funded from a seed, pre-seed basis, which has gotten bigger rounds up to $5-10 million in that stage, which was unheard of 20 years ago, 10 years ago, are being done by not venture capital firms mostly, but by other successful founders who have their own little solo GP fund, or they are at a firm where they trust the other founders. So I think, Laud Ventures with Andy and Pete are really going to be interesting to look at. And I think this is where you're going to start to see the new formation going with venture capital, as the deal flow is going to come from not your traditional, VC model, but it's going to come from those old school, used to be scouts and feeder networks. There'll be real rounds done. So I think the game is going to change in venture capital. It always goes through this every 20 years since in my observation as a founder and working close with venture capitalists. You're going to see a lot more mutual connections. It'll be much more democratized social network. Referrals and references are all going to be tied in. So you watch the moves of the top VCs at the early stage. It's the nimbleness of these new ventures. So again, the success speaks for itself. And once you get that flywheel, you're going to start to see new changes. So congratulations to Pete Soncini and Loud Ventures. It's 150 million. I just checked it out. You forwarded to the big story.
I got a
So
question for you. I got a couple questions for you.
Sure.
You said on the Databricks thing, if I go back to that, you said, why go public? So I want to ask you, why go public? I mean, you saw what happened to Cloudera. They waited a long time. I think there are advantages to do an IPO in terms of just visibility and trust with customers, and the quarterly shot clock that gives you an opportunity to communicate your greatness. What are your thoughts? I mean, it's interesting that you made that comment, why go public? And then my part B of that question is, what's your outlook for IPOs in 2025?
I think it's a good question. There's two things there. One is I think when you raise that much money, I mean, we've said this many times on the Cube Pod, Dave. I'll just rehash it through. The whole idea of going public was to make a market for the stock and give retail investors access to the stock, but also provide liquidity for the investors, and also to raise money. So, the old school way of going public was to raise capital. So you'd sell stock on the offering, and that's where everyone had liquidity. I wrote a post when Facebook raised their round with Microsoft. I think they raised $200 million at over $1 billion valuation. Everyone was going, "Oh my God, that's so crazy." Look at that now. I mean, you can almost compare like the Nvidia people going, "Is it overvalued?" You don't know what you don't know. And I said at that time that there was a private IPO market happening. And what I mean by that is that when you have shares changing hands on secondaries and these insider rounds and these markets where people sell employee shares or investors get liquid, they lock in their returns and then they're playing with house money. So the investors are getting liquid, the employees are getting some liquidity. Now it's a little bit not democratized, it's probably directed and intentional. That's okay too. It takes the risk management side, but that takes care of the liquidity. Fundraising, $9 billion. I mean, what do you do at $9 billion? It's not like they're building a fab factory or a cloud. They probably are building a cloud, but that's a lot of cash from a working capital standpoint. And they're going to do billions of dollars in revenue per quarter, and ultimately get to like a $10 billion run rate. That's plenty of working capital because they can continue to lose money, but they're also making money. So fundraising's off, liquidity's off. The only thing left is the retail investor. That's the issue. So, you know, okay, 2 out of 3 stay private. Just do another round. I think it's Series H. That's my rationale.
Now, what do you, so the, I was talking to Peter McKay last week when you and I were doing the AI and cyber innovators. He had a good narrative on this. What he said was, I think the first half of 2025, you're going to see some IPOs, smattering for those companies that need to go. Now, he said we being Sneak have, $400 million on the balance sheet, more 400 plus. We don't have to go. Veeam CEO, Anand said the same thing. We got a great balance sheet. We don't need the cash. So they're not going to go unless they need it. Those companies do an IPO. Second half, we'll see. I mean, the 10 years back up to like 4.5. The Trump trade is unraveling. So who knows what that's going to look like? Looks like the hawks are out. We got the last quarter point cut that we're probably going to see for a while. Although the inflation data today, I guess, was positive, so people are sanguine about another rate cut. I guess I got to dig into that. But so it's hard to tell what. I mean, I don't know. Is the S&P 500 going to be higher or lower after the year after the inauguration? Who knows? We'll see.
I think the IPO market. The other part of the question is that I do think there's going to be a liquidity market, but even the NYSE is working on an index on private. So I interviewed the person running that program. I think they're with ICE. I don't know if they're with NYSE, whatever. But why not keep track of the index? Why not track the pre-public IPOs? Why wouldn't they? Market's the market. Now, it's not an actively trading market, and ideally you want a robust market to actually get accurate, actual equilibrium in pricing. But it's crazy. But I think the market will go public. I mean, if I'm a retail investor, I want to get into some of these. You can't always get into those private rounds. Usually goes to like the institutionals, like the Fidelis of the world and the big capitals. So, I think there's going to be a swing back again if the Dow keeps losing money. I think yesterday they broke the streak of 11 consecutive down days. So there was a little concern there for sure. Everyone's kind of like shaking their boots a little bit, but I think once Trump gets in, and if an NFC team wins the Super Bowl, Dave, it always happens to the stock
Oh
market.
well, but that thing that broke the trend, didn't that break
Yeah,
that
Patriots
trend break?
ruined that. Patriots killed that whole
Yes,
probability.
that's right.
But the Chiefs could win it again. Who knows? But again, all kidding aside, I think it's going to be with Trump. I think you'll see a good market. Again, don't listen to me. I'm not the one to predict it, but I feel like unless the war and the global World War III happens, I think the market will still be robust. I think productivity will kick in. I think people will realize that AWS is undervalued. NVIDIA is still a long play. Apple, right now, Apple's safe bet right now. It's a safe harbor the past couple of days. You look at Apple stock, anyone who predicted Apple Who's going to not be a winner is a total fool.
Who are you talking about, John?
Analysts who go on TV and say, don't buy Apple. I mean, they should never be allowed to be an analyst anymore. Um, but I mean, I think that's, all kidding aside, that's, people don't understand. We don't understand large scale applications. And remember, we said this all the time. We said this during COVID. The hyperscalers, the cloud players, AWS in particular, Microsoft Azure, Google Cloud, and Google Cloud is producing some pretty damn good product right now on the
Yeah.
AI side. So they're getting a great reputation. Even Oracle, you always throw in Alibaba, we'll throw them in the mix. You have hyperscale economic engines that weren't around long enough, in my opinion, for the financial world to understand the impact of the productivity. I mean, it really is only a decade, if at least, where you see the total horsepower impact of what cloud computing has done. And I had an interview with Bill Tai this week here. Bill Tai is a prolific investor. He's also the founder of ActTai, which is an organization community. He's involved in crypto. He's involved in healthcare. He's made great investments. He was the first employee of TSMC. You know that? He
Uh,
worked for LSI.
I
He's
know he
related.
was I know he was an early employee. I
Number
always
one.
thought more.
Number one
I
U.S.
thought
employee.
yeah, I thought Morris Chang was number one employee.
He
But
was
yeah,
the first
okay.
U.S. employee. He worked at LSI. He's related to Jensen Huang. He's highly connected. Good friend of theCUBE.
Great
Great
guy.
analyst. Was a great investor. Continues to invest. He invested in Canva's seed round. He invested in Zoom when no one would invest in Zoom early on. And he's got Treasure Data, which we know we covered since day one. Many, many more. He talked a lot about the fact that a lot of this early data coming in is mixed, and that currency hasn't been around for. He's very bullish on Bitcoin, but he's also very bullish on the fact that these ventures that are going to come out are going to have a challenge because data centers are sold out. Basically, there's no power, and crypto is not going away either, Dave. So the contention for data centers right now, data centers powering all the crypto. When we talk about power and cooling as a great hot trend, well, how about this hot trend? Space, right? There's no space left, right? So for data centers, power is one thing, but there's not enough data centers. If you look at the capacity of what is on the schedule to roll out, it's the equivalent, to use his words, the equivalent of 40 million homes. That's the amount of power that's needed to take the expansion of the current capex of the hyperscalers and big players. Just what's proposed, not what's coming beyond it, not what's existing, what's proposed, is the equivalent of 40 million homes. So how long does it take to build 40 million homes? A long, long time. So we have to, in a short period of time, deploy CapEx to power the equivalent of building 40 million homes. That's why nuclear is on the table as an option. That's why Amazon, Oracle, Microsoft, everybody is looking at nuclear energy. There's just not enough power. So that is a big factor that could come into the market and create dynamics, frankly, that could take it sideways a little bit. I'm just throwing it out there because it's it's a force majeure, as they say. It's a thing that's going to be unpredictable, like a tsunami. It happens when it happens, and when it does, shit
Well,
happens.
and you got a couple, another couple of things going on. Amazon workers going on strike. Timing is unbelievable. What's the date today? 20th? Oh my God. And then the government, threatening to shut down. I don't know. I was watching last night. I had the thing on in the background, the vote. It needed a 2/3 vote. They didn't come anywhere close. So it's interesting, right? Trump maybe doesn't have the power. Of course, Trump came on today and said, it's Biden's fault. I'm like, come on, man.
Not on my watch, he said.
Biden, yeah, but Biden is nothing. Biden's done. He's out. But Trump's running the country. You can't be pointing fingers at Biden. So that's more stupidity from government is what we're seeing. And so, how's that factor into the whole tech trade and the economy? We'll see. I think. Look, here's my take on this. I do think you're going to see a lumpiness because we've had a lot of momentum, and we are in a little bit of a bubble here, and so. And the Trump administration is picking this up, not at the low point like Obama did. Obama, came in right after the worst financial crisis of our lifetime, and so he had nowhere to go but up. And they put in so much money into the system. You got a different situation now, so there's a lot, right? There's a lot of pressure on AI. right? To drive, if they're going to cut taxes and they're going to try to spur all this growth, how are you going to pay for this? Well, the way you're going to pay for it is, AI spurs that growth and throws off, more cash, and then they have to have the discipline to balance the budget. As Milton Friedman said, you can't attack the debt until you attack the budget deficit. If you spending more every year, your debt's going to keep going up. And so AI, is up, is on the line, and is the favorite to win the race, but it better perform or the economy is going to feel it. But I think it will, but I think there's going to be some lumps along the way. I think look at Intel. Intel is only a couple of years, 3 years into Pat's vision, and people are like giving up on it when everybody knew, anybody with a brain knew this was going to take 10 years. They've already given up on it. So, the market is fickle. It will give up on the AI trade. It'll pound it. And then, as always is the case, John, it'll come back with a vengeance and exceed our expectations. And that's, I think, what's going to happen here. Right? You've been calling that at some point this bubble is going to burst, whether it's semiconductors or NVIDIA or, something's going to happen.
I don't think it's going to be a burst, Dave. I think it's going to be a light, think of it as a balloon popping. It's going to be let the air out slowly because unlike the dot-com bubble, this bubble has too many real use cases. And the dot-com bubble, the use case was user experience and online population growth, which funded the browser, which only was one because Microsoft's monopoly crushed Netscape. So that was game over. So there's no market there. Search engines had made no money because they converted to portals, if you remember back in the day. Paid search didn't come in until after the bubble burst, where that kicked in with Google. Last search engine standing, I called it, and Yahoo, which is a portal, had traffic. Outside of that, the people who won that market were enterprises, but they weren't monetizing the web pages. They made money by having a better efficiency with self-service, but there was no business model for the category called the web. So unlike that, the AI, there's plenty of picks and shovels that are going to be monetizable. There's no monopoly. NVIDIA, you can argue, we've said before, I'd say they are monopolistic like in their user mind share and customer mind share, but they're enabling a lot more growth. And the AI, there's plenty of low-hanging fruit use cases for companies. Now, there's definitely a overinflation of companies that are more features rather than a company. But unlike the old model of there's got to be a pony in there somewhere, kind of like there's a feature, not a company. You can actually make a lot of money with a feature that disrupted and take a category down. So I think what's different is that you'll see survival, but not nuclear winter like the dot-com bubble. And for the folks that are listening that didn't live through that, let me tell you, the dot-com bubble was as nuclear winter as you could get. It was complete decimation. It makes the financial crisis look like a picnic.
Well, from a tech standpoint, I remember going out to Silicon Valley. It was years before it came. It was really the Google IPO that brought it back. But Silicon Valley, you lived out there. It was empty. I remember
it was a deep freeze, man.
Brutal.
It was bad. It popped, and it was just carnage, frozen tundra everywhere. There was no opportunities, unemployment. People got stuck with tax bills of profits they never had. Families were destroyed. Businesses were crashed. It was destructive. It was really, really bad. I lived through it with two young kids, trying to do startups, and it was really, really difficult. No one will ever see anything like that again. And all the people who cry all the time, I see on the internet, oh, it's so hard. Like, dude, you haven't lived through the dot-com bubble.
Yeah. Well, the thing is, too, the dot-com was just so full of fake companies. But I would say this very often.
The dot-com bubble, everything that went under happened. Pet food online, shopping delivered.
Yeah, but look at storage networks, the cloud, right? But at the time, the business model didn't support it because there was no cloud and there was no mobile. So that was a couple of catalysts. But I would say this many times, as you know, I've compared the existing AI wave to the internet in terms of how incumbents are going to be able to take advantage of it. And many, many differences. I mean, the companies here are real. It's being funded by massive CapEx and stable companies with great balance sheets, the cloud companies, the hyperscalers. But one of the things I will say about that's a similarity of the PC wave is, a lot of people won't remember this, but I'm old enough to remember, there was like this great softness in the transition between the era of the mainframe and the mini and the transition to the PC. And what was happening is that the PC was so much more cost effective, but the revenue wasn't big enough to offset the decline in the earlier wave. And so there was this sort of great softness. It wasn't a bubble burst, but it was just this kind of, winter came and hung out for a while. And I think that could very well happen here
In
with the
in the
AI
PC
wave.
or the internet?
PC, the
PC was fine.
transition.
I mean, I
No,
didn't
no, it
see any
wasn't.
implosion.
It was the, no, no, actually, there was this year or two of sort of hiatus and growth, and
What year
IT
was that?
spending was really flat. It was post the 87, post Black Monday,
Yeah.
when we were sort of leading into the 90s. So the transition was really it was the handoff from the 80s to the
Yeah,
90s.
that was a recession.
As IBM's monopoly was unwinding, all the mini computer guys, all the East Coast mini computer guys were
Yeah.
getting crushed, and they were hanging on to the past as they, the Wang, Prime, DG,
Yeah.
Digital, Apollo,
That was the 80 recession.
and it was well, it was late 80s, right? Early
Yeah.
90s, George Bush the elder. And so that was, that was a sort of a tough period of time. Um, and so but I can see something similar happening here, and if you combine that with some kind of existential threat or some black swan event, yeah, I could see the market taking a hit. I remember Ken Olson came up to us one time when we were at IDC, and he's, I don't like your forecast. Ken Olson was the chairman and founder of Digital Equipment Corporation. He was an icon. He was like the Jensen of his day, And he came up, I don't like your forecast. Well, why? Yeah, they're all straight lines, and that's not how markets work. And he was right. I remember thinking about that, like, okay, but how do you forecast, these inflection points like the VIX? It's just really hard thing to do. So you end up, smoothing out the curve. And so this will not be a smooth curve to the moon. Let me just put it that way.
Well, I mean, I think I have a perspective on the dot-com bubble comparison to the PC revolution. If you look at the 80s, I was in college at the time. Microsoft and the PC was in a platform transition. So 8086, okay, 286 wasn't even on the radar yet. It was still an 8086, 8088 processor. Windows was light. Microsoft Office was emerging, and you had no local area networks fully in place yet. So I would say that that combined with the recession at that time, there was a little mini recession that hampered hiring. I remember Hewlett Packard, where I went to school, went to right out of school before IBM. Before I did that with IBM, I saw that firsthand. I was kind of insulated by being at the big company, but that was happening. But if you look at 1990 and beyond, the Wintel kicked in. So I consider that the real PC revolution days. Because when you had the Wintel kick in, that's when you had processor innovation, memory. Now, if you remember back in the 80s, Dave, what was the big bubble? Disk drives. Remember the Winchester disk drive bubble? Again, they're dating ourselves now, but like there was a huge disk drive bubble. In fact, books were written about it.
There were
So
85 Winchester disk drive companies.
I can't believe I remember that
85.
shit.
There's two today. There are two.
I
I used
remember
to
this
follow
stuff.
that market very closely. The Winchester disk
I
drive
know, that's
market
why
was
I
a
brought it up.
negative. It was a negative cash flow business perpetually. It was like the airline business, except worse. And
Winchester disk drive. I can't
it
remember. I
was
remember this
terrible.
stuff.
But you remember if you remember, they were getting funded like crazy. VCs were pouring money into it. It was just horrible.
IBM
But
invented the disk drive, the Winchester disk drive. And it came from an early type of drive developed by IBM. Had a 30 megabyte of fixed storage. This was on the 3270, 370 mainframes, and they tried to shrink it down for the PC. Remember, that was the big bubble.
but what happened was, so IBM
It was a
peaked.
venture capital budget bubble too, by the way, big time.
Yeah, absolutely. But IBM peaked like in 1990, 1991. And then IBM was playing a financial game, which was interesting. They were converting their rental base into sales, which was the opposite of cloud, right? And so they were taking their rentals and then turning them. They were just playing income statement games, and so it was propping them up. And I think they had peak earnings at the time, like in 1990. And then it was just the whole mainframe downsizing thing happened. There was what we used to call the great softness, and it lasted, a year and a half. But it didn't. It wasn't a bubble burst, but it was like, what's going on? And again, I remember that, and remember
It
analyzing it
was
and saying that.
excessive investment in the
Well,
space
but at
with
the same time,
overvaluation.
you had this big base of business, this legacy business that was in decline, and the new stuff was so cost effective that it wasn't throwing off enough revenue to offset the decline in the old stuff. And people, the investors were confused, and they were investing in the new stuff, but it wasn't growing. It was growing. It was growing very fast, but it wasn't big enough. And so the difference here, of course, is the big three clouds have, they each have $100 billion businesses. I mean, they're enormous. And so,
But
I
you were an
wouldn't be betting
analyst,
against
so
them.
in the middle 1983, the capital markets assigned a combined market value of $5 billion to 12 publicly traded venture capital-backed Winchester disk drive manufacturers.
I
Between
could probably
19
name them.
between 1977 and 1984, 43 different manufacturers of Winchester disk drives received venture capital financing.
There you go.
Now, just to put it in perspective to people listening who weren't even alive at that time, or even understand the bubble of this was, just to put it in perspective, Dave, you could probably scope the equivalent magnitude of what that means today. Venture capital was a tiny industry. Okay, so for you know, um, 43 different manufacturers, that's like basically investing in every AI company there is today. And 5 billion at that time, Dave, how would you scope the order of magnitude um, equivalent of 1983 time frame, say 83 to 87, of $5 billion of publicly traded value, and the idea that um, 43 different
Oh my
VC
God,
backed
that's like,
companies,
can you
like
imagine? For
scope the equivalent of what that might look like today.
I mean, the market was like, think about it. The market was like maybe 10 to 15 billion. And you're saying, 5 billion you're saying was invested? Right? Can you imagine? For
No, that's the combined market value.
oh,
That's the
okay,
combined
of those.
of 12 companies. In 1 year, it was a billion. It burst, basically.
Well, I mean, I don't know how to do that. I mean, to translate it in today's value, but it's like, well,
The the
amazing thing.
average PE was 54.
Oh my God! So that and for a negative cash flow business that was the most cutthroat business. Al Shugart said to me one time when IBM was trying to get into the OEM business to compete with Seagate, he said, "Yeah, the disk drive business is a schlocky business, and IBM's
Schlocky.
not a schlocky
Did he really say that
company."
word, or did he
He
really say
used the word
something else?
schlocky. Al Shugart was a legend. IBM's not a schlocky company. They'll never make it. And it was interesting. Al Shugart decided to go vertical integrated, and he dominated that business. And I think about Pat and his desire to be vertically integrated, and I get it. If you can win the vertical integration, you can dominate. But that was never going to happen, and that was misguided by the U.S. government. Allowing him to convince them that it was the right thing to do. And of course, Trump's going to use this now to say, see, I told you the government shouldn't be involved in industrial policy, which, by the way, maybe it shouldn't. But anyway, that money is appropriated. Like, I don't know, $50 billion is appropriated, and not all of it has been allocated. They should claw back what they can and rethink how they allocate it.
Well, we're getting down to the wire here on a very cool end of year. How you feeling? I feel like we had a great year in terms of the cube, the industry. Obviously, it was a very busy back end. Super exciting activity on the editorial side, the research side, of course, on the events. I want to thank everyone who's listening, who's been a sponsor of the Cube and our mission and SiliconANGLE Media. We really appreciate you. We had a really great year. More importantly, is just the original content that's coming out of the network effects. The NYSC studio has been a great new addition to the mix. Our research team's growing. Our production team is growing and changing capabilities and growing capabilities, more in studio editorial. And then just a number of events. I think this year will be a tsunami of events because we've perfected the digital twin hybrid, doing physical events and bigger events. I mean, just recently, Dave, the CFO event we did, it was 2 weeks ago we decided to do that event.
You know,
Ryan Bauman and I was sitting around having dinner, and we're like, hey, we should do CFOs too, because they seem to love the cube and they have a lot of compelling stuff. And we saw RSA CFOs talking to us about stuff I never would thought of, like why isn't data differentiated by the value and the insurance premiums be different? I was like, wow, that is totally legit, but they're not. There's one premium. So I'm like, wow. So this is how fast we're going to do events. So this year I got CES I'm going to. I just got some emails there, IBM, Broadcom, a bunch of other meetings. Um,
I
you
just want to
got
make a
NRF in New York. We'll be at the NYSC, 3 days of media week there. That
in
should be phenomenal.
January, right? And so, I just want to say something.
February, Brian Bauman and Kim over at NYSC were collaborating on a CMO media week here in Silicon Valley. So
Okay, and
CMOs are coming on.
so let me make a comment here. So when you and I met, you had started SiliconANGLE, and I had started Wikibon. Both of us were passionate about free content, serving the audience, and that's how we started. That's how SiliconANGLE started. Is like we didn't really have a business plan. We just said, let's just do good work. Our uh, our founding statement was Gartner Group for free, literally in a hotel room in Mountain View. And that's what we did. We said, we don't know how we're going to make money. Let's just serve the audience and we'll figure it out. And
What,
that's
the
what happened.
Wikibon's value proposition?
Wikibon was,
Yeah.
we wrote on the back of a business card, Gartner Group for free, and then started thinking about it. Well, how would you do that? And so that's what, and we feel like we made a mark. And then of course we merged and great things happened. And I will say, look, so first of all, thank you to our clients who allow us to serve our audience, because over 50% of our content is, and this lately is well over 50%, is free and open, not sponsored in any way. We don't monetize it, and we don't monetize SiliconANGLE. And maybe that's an opportunity for our business down the road. But
Yeah.
the great thing is we have wonderful clients who enable us to serve the audience. And yeah, we connect brands to the audience, and we have services to keep the lights on and actually grow our business, which is phenomenal, and our employees work really hard. It's a difficult business model because we are passionate about serving that audience. And on our business, in the analyst business, it's always about, hey, you got to do white papers, or you got to do webinars, and that's kind of secondary, really, to not even secondary. It's really not our mission. Our mission is to really serve that audience, and yeah, we got to provide services so that we can afford to do that. And our clients have been
Yeah.
super helpful in enabling us to do that. And I see, John, just an increase in the amount of editorial that we're going to be doing in the coming year, and it's
Yeah.
exciting.
I mean, marketing's changing a lot, and how people engage with the audience is changing a lot. So, I think I'm really excited by the video AI cloud that we have coming to market. We've been using it, our video data lake, since 2012. TheCubeAI.com is turning into quite the Cube Retriever product. I think, in talking with Kent Libby and Frank E and the team here, um, we're going to see some really quick end user facing products, and we're going to start looking at how people want to use it. I think it could be a very valuable tool, and I'm thinking about giving it away for free, Dave. I mean, I know, we tend to like to give away things for free, but I think it's a huge benefit. The ability to provide real time insights with video has been quite a rewarding thing, and I think the long game in this business of media is to leverage the data, which is the authoritative content from our research team, our publishing team, and our video team, but more importantly, the people we interview. And having that, someone said it's like a Bloomberg terminal that's open source. And I
I
very much
remember
see
that.
it. I very much see open source content. As you know, that's my rant. I love talking about this, is that no one's applied open source principles to media as the same as open source software. Having lived through that open source revolution, when things were proprietary, I hate to see stuff not get out there. It's like a company that creates great software, proprietary software, and then the VC screw it up or that goes under, and then the software's gone. It's not leverageable. Remember Doug Cutting used to talk about that on theCUBE all the time.
Yes,
His
the
whole
founder of
passion was
Hadoop.
he worked on a startup and he built this great software and became an asset yard sale, and it never saw the light of day, his work. And I think content in this world of creators and repurposing and derivative works and remixing, and when there's community involved, you're just going to see that. I think the Cube has become like the Linux foundation of media, where, hey, keep it open, everyone wins. That is a very different approach than paywall. And then, I mean, I tried to search some links from Kara Swisher's old site, Recode. They're all gone. Poof, gone. So
And they were high quality
it,
journalists.
it
I mean,
was it was such a tragedy. Kara's articles, Walt Mossberger was in there. I mean, and everybody, right? They had a great team. So I think open source content is just like writing software. You write code, you're in the project. You build content, you ship content, you create content. If it's good, it gets adopted. If it's good, people can leverage it. I think that's going to be a licensing. I had a great conversation with on the Cube here on the CFO Summit with Annalisa Gooden. She has a company called Catch and Release. She's dedicated to the mission of licensing content for creators' benefit. Um, Great mission. So I think you're going to see this year start to be the beginning of where people look for really three things in companies that are doing content and with AI: authenticity, originality, which is accuracy, and valuable, and then three, trust. Right, those three pillars. And again, that we are that's our first principle. So get things out in the open, be authentic about it, podcast style, make it original content, real data, valuable data, not just some recycled warm take with some haymaker on some influencer blog. And then finally, trust. Community is ultimately the metric for trust. Who's who's endorsing you basically. And I think if that scene in Gladiator, win the crowd and you'll win Rome. Remember that line?
Yes, of
Yeah. Are
course.
you
Yep.
not entertained? Yeah, if you win, if you win the crowd, you'll win Rome. That's the media business, and it's not about where they
Yep.
went to school or who they are. They bring the A game with content. It's going to grow. It's going to create a community. So, I think network effect validation will be a big thing. So again, you'll see a lot of that this year from us. Of course, Dave, we get the prediction posts. Don't forget those.
I got a
So
bunch coming up. I'm doing one. I'm doing a post with the Data Gang every year. The Sanjeev Mohan and Tony Baer and Doug Henshin and Brad Shimon and
yeah.
Carl Olofsson from IDC. They join us every year. I hope I'm not forgetting anybody. And so we do like a deep dive on data. And then I do one with Eric Bradley. And then we're going to do one with the Cube Research as well. So we have a lot of predictions. I have a stack, John, of inbound about this thick of people sending me predictions. I print them all. I review them all. It takes me a day to just go through them all. And then, I cherry pick them. Yeah, I have to be honest with you. Most of them are like, AI is going to be a big wave. It's like, okay, agents are going to be a big thing. I mean, but
Yeah.
some of them are really good and make you think, and they give me ideas. We like to do predictions that are
Yeah.
binary. Like, did this happen or not? And was it right or wrong? And so I do a review of my predictions, a grading of my predictions
Yeah.
every year. A lot of my predictions don't come true because I try to stick my
Yeah.
neck out. But
Yeah. I mean,
oh,
one prediction that happened that I didn't see happen this year, and I'm going to predict it's going to be more relevant next year, is the confluence of impact investing with ventures. And my eyes got
mhm.
opened up when I met a person named Elliot Donnelly, who runs a group called First Global. He introduced me via Brian Bauman to John Mack, who runs a nonprofit around preserving humanity. And I love philanthropy, but I'm also just focused on, on building our business, and sometimes don't give enough time to thinking about doing the right thing. But I think we're in an era now where, as people become so focused on mission, that they cannot be ignored in the capitalistic system. I think you're going to see an integration of impact finance and capital structures merging with capitalism, because we're in the data business now, the data gravity, the data fusion, merging of networks, trust networks, as we talk about. I think you're going to see the convergence of funding, because there's so many overlapping interests now between philanthropy and impact investing, like sustainability, data centers, climate change, um, journalism, saving journalism, rebooting journalism, the future of work. I think all aspects of society are integrated with digital. I think the digitization of digital transformation and the business model or the society model is going to change. What does it mean to be human? Empathy, all these things that were kind of touchy feely are legit integration points into our world, because AI will have to reflect humanity. And we all know the numbers. The people who write the software and write the models isn't 50-50. It doesn't represent the global economy. So I think people of dying affect change, and I think you're going to see an intersection between financing models. Elliott, for instance, is been passionate about and been over a decade working on capital structures, how to incent entrepreneurs and business, not just kind of like a showpiece, but like as a legit integrated workflow of financing and capital structures, hybrid nonprofits. He's got one-click nonprofit where you can create a nonprofit entity and raise money from all these capital sources. So it is disruptive. I think this is going to be a conversation because a lot of the climate change pledges have to do with data centers, right? It has to do with human things that affect us. I mean, data centers affect climate change, but like look at the TikTok ban, right? The big threat that almost happened. I mean, I think the news that we reported on the TikTok ban, Dave, was um, clear. It was a threat by Trump. Looks like it's gonna, they're making a bid to survive. Next month, TikTok could be shut down. Is that a good thing or bad thing?
Well,
Well,
you always said leave it alone. I was always saying, well, we should put China on the
I
spot
don't
and
think I said
make it
leave it alone.
reciprocal.
I don't think I said leave it
Well, no,
alone.
you said don't shut it down.
I don't think they
Basically, you
should
said,
shut it down. They should. I think they should just
right.
take it over in the U.S.
Oh, okay. So we agree. I mean, I think, yeah, but
Well,
that's never
yeah.
going to happen. I feel like there should be reciprocity. If
If they
we
shut
can't
down
have Facebook,
TikTok, there'd be a revolt. Everyone,
if
whatever Democratic
I
Party
know, but
supports it,
just
will win the next election.
it's just talking about what's the right thing to do. Look, if we can't have Google and Facebook in China, why are we allowing ByteDance to run TikTok in the United States?
you know, if you shut down TikTok, it reminds me of the GameStop revolution. Remember when the GameStop stock went crazy? Had nothing to do
Sure,
with the
the
performance of the
meme
company.
stocks. Yeah, sure.
That was the crowd just going crazy. I think you're going to see crowd dynamics. And TikTok, when they go revolt, there'd be a revolt. There'd be a
All right,
revolt.
let it go. Who cares?
All right. Well, Dave, great to see you. Have a great Christmas on your
Yeah,
end. Happy
have a good
holiday to
weekend,
you.
John. Thank you. You
We'll
too.
see you on this side, and everyone have a great holiday.
Be safe,
And
everybody.
you'll get
Thanks
a
for all
call.
your support.
Thanks. See ya.